Hello, everyone. I'm going to ask the panelists to just briefly introduce themselves. Do you want to start, Sean, in
Sure.
1 minute?
So my name is Sean Park. I'm the founder and chief investment officer at Anthemis Group. We're a hybrid firm, both advisory and investments, focused uniquely on financial services. We like to say we invest in companies that are building disruptive business models enabled by technology. So that's not as sexy as fintech or short as fintech, but I think it's a better description of what we do.
Philippe?
Philippe Colombal, I am the managing partner of Partech Ventures. Basically, we manage 3 funds, a seed fund, early stage fund, and a growth fund. And in total, we have an investment capacity of around 800 million under management. We don't invest uniquely on fintech, but I have a strong focus on fintech. We did 13 fintech deals in the last year, one of them in common with Sean.
So I'm Anne Herrera. I'm a reporter for Financial News, which is a Dow Jones paper in London, and I cover fintech, which is not as a correct definition as what Sean said, but it's shorter and it fits in a headline. So the topic of this panel, I think, and this is why we have 2 great investors here, is to kind of look at where we're going with investments and, in general, whether fintech, is it a hype or is it sort of a long-term trend? So I'd like to start with the controversial question, which is, Sean, do you think kind of fintech is a hype? We've seen investments reach kind of peak for years. I think 3 years in a row they've been peaking globally, and then they kind of dropped in the 4th quarter. What do you expect this year?
Yeah, so I don't know what to expect this year. Our time horizons that we think on are 5 to 10 to 20 years. So in that context, I think we're only at the very beginning of a reinvention of financial services enabled by technology. Of course, in any long macro secular trend like that, you're going to have ups and downs. I know it also doesn't make for very good headlines, and I know I think the business you're in is very difficult these days. You need to capture people's attention. So I call it the CNBC-ization of financial press, where everything has to have a reason why it's going up, 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 or down, down, down. But I think there is a little bit of that element of it's the flavor of the month or flavor of the year. I think net on that longer horizon, that's a very good thing. It brings lots of people into the space. It creates the conditions for momentum, and one of the downsides of that is there are going to be excesses in certain areas in valuations or companies that that don't succeed. But I think if we look back, if we're 2016, if we look back in 2026 at the landscape, I think whatever happens this quarter or even this year will seem irrelevant in the larger scheme of things.
Philippe, do you have any views on, I guess, valuations? Has it become a bit more pricey?
Yeah, you need always to realize that the prices are still led by Silicon Valley, and Silicon Valley is a binary economy. Either they invest like crazy, valuation are up, or suddenly they are at the verge of the cliff and everything stops. In the last quarter, 2015, everything has stopped. We spoke before the panel. January, that was the beginning of the end of the world. And since March, it's picking up again. And in fact, as Sean said, for us, it's just micro trend. We don't care. Fintech is there for the long term. It's for me, it's a trend that's going to stay at least for another 10 years. It's a perfect time for investing because valuations are more reasonable, and that's it. We see great investors, we see great entrepreneurs, and what we find interesting is that the fintech that started with banking is nowadays everywhere, from fintech to health tech and that's something that's going to create another trend of great investment opportunities.
So how do you manage to pick the companies you think will be there in 2026? And given that maybe some people might just say, oh, we're fintech now, because that might attract more attention than saying something else. How do you distinguish what will be truly like digital financial services and not just?
So I can only speak to our approach, which I think is a good one, but I don't think it's the only one. We're very much thesis driven. So we start with fundamentals. We have a very deep and developed thesis on the macroeconomy and the structure of the financial system and how that's going to evolve. And using that as a sort of a baseline, then we put ourselves in 2026 and we say, okay, what might succeed in 2026? Given the way that we think the world's going to evolve, and when I say the world, I really mean, you know, our culture, our society, institutions, technology, of course, but not only technology. And then we work backwards from there, and we develop micro theses around various different sectors of financial services. So that's sort of the baseline. Then the second part of it, I would say, is more generically good practice in venture investing, which is the classic three pillars of the stool: team, market opportunity, and product. And you need all three of those legs for a company to succeed. But at various different stages in their life, each of those legs is relatively more or less important. So, for instance, the and we're relatively stage agnostic. Although historically we've invested more in the early stages, I think that's more a function of where the market was. That's, you know, 5, 6, 7 years ago when we started, there wasn't any later stage fintech companies. So in the very earliest stages, I would say the team is really what we look for, and we look for all the obvious things in good entrepreneurs. But where financial services is different, or actually it's probably the same as under other industries, but you know, we look for a real understanding of the marketplace. That often comes with deep domain experience historically, but not always. You don't have to have worked in a bank for 10 or 15 or 20 years or an insurance company to have those skills. Most of the entrepreneurs we back have some element of that, but you can also bring sort of a deep knowledge. I would use the Elon Musk. You can learn about this stuff, but I think what we look out for and what we avoid is the sort of Johnny-come-lately entrepreneur, that it's a hot sector. And I remember some conversations actually I had in the Valley about 6 or 9 months ago when everything was Uber this, Uber that, and we were talking about I think we're going to come back to regulation. We were talking about the regulatory environment for financial services, and a VC who will remain nameless said, you break things and move fast and break things and fix it later, just like Uber. And I pointed out that the Taxi Commission of New York was not exactly the same level of risk as the SEC or the Department of Justice or any other, you know, international or national financial regulator. Market opportunity is important. We see a lot of companies with great founders and a good idea, but the market opportunity just isn't there to grow a big company that's venture backable. That doesn't mean it's not worth doing. Sometimes it means that, but not always. But, you know, we're looking for certain returns, and we need companies that succeed to become big. And then the last thing is actually the product or the idea. Now, that might sound counterintuitive, and I'll remind everyone you need all three. But that's the easiest thing to fix if you've got it. And almost by definition, again, in the earlier stages, you'll have something will be wrong with that. And if you have a good team and a great market opportunity, you can figure out the product or the service.
Philippe, what are some of the things you guys look for?
Well, it's difficult to disagree with the approach. Basically, just to complement, we have investment thesis, but more importantly, we have sectors we don't want to invest at a given time because, and I will come back to that, the unit economics doesn't make sense. And I will come back later. Of course, team, I always say team, and team. What is interesting in fintech is that very often you see a combination of industry expertise and entrepreneurial skills, and we have a good example in our portfolio. What we don't like is exactly the latecomers. Just an example, yesterday I saw a company, and it was all about peer-to-peer insurance. And I asked the founder, but why did you start that? He was before an executive in the automotive industry. And he told me, oh, my wife works in insurance, and she told me, it's a great market. After 15 minutes, the guy had no answer whatsoever on any real pretty deep or even basic insurance questions, and that doesn't make it. And what is interesting is that these days we see more and more former banking executives teaming up with entrepreneurs. Second pillar, just to develop, is a market. We are looking for large markets. Just an example, a $100 million market a year is probably a good business, but it's probably not VC backable. For example, I funded Countox in the peer-to-peer foreign exchange. It's a $5 billion daily market. You don't have any question about the ability of the company to scale. Third element, product, of course, but also business approach. We saw too many initiatives, and I can give very precise example. Asset management space, for example, robot advisors, where the unit economics didn't make any sense. Their CAC, customer acquisition cost, was about 500 euros, and they could extract maybe 60 euros of value per year. That didn't make sense, and that's exactly the kind of approach that we take at Partech. We avoid 20 sectors where we see a bubble going.
So I'm going to get you arguing now. But Sean, you have backed a robo-advisor, which is doing quite well, right? Betterment. So yeah. What was your, I mean, it was obviously way before.
They invented the category. So I think, you know, it's interesting. We actually have a tag in our database. It's yet not another undifferentiated robo-advisor. So I think when you're building markets, and we were fortunate enough to back a team that is defining the category, maybe with one other company, and they're growing at an enormous pace. And that's an interesting example, because now we're, as I said, I think we're still in the very early innings, but we do have a little bit of history in this market. And one of the first questions I'll ask, if they manage somehow to sneak through our filters to one of these undifferentiated robo-advisors, is, okay, forget about Vanguard and Schwab and Fidelity. How are you going to be Betterment? These guys have built a machine, and the unit economics are, you know, this is one of the fabulous things about fintech, is you create these very, very efficient business models, and the economics and the business models are an order of magnitude more efficient than some of the traditional players. But if you're coming in and you've already got players like that, that have, and you know, they're later stage now, but they're still a startup, so I don't want to suggest they've got everything figured out. But if you're starting fresh, you know, where is your differentiation? And again, I'm not saying we're always on the lookout. And I joke with John and Eli, who are the founders of Betterment, is like we gotta start talking about, not daily, but maybe quarterly, about how we get disrupted. But you know, there's a difference between category invention and following on or cloning.
Are there some areas that you think are saturated completely, and some areas perhaps that you're really looking for something but you can't find anything that's quite there yet?
Yes, of course. But I think we should reflect on the sentence of Sven. It's not a matter of being saturated. It's a matter of bringing something new to the table. Just an example: the companies that I backed in France is peer-to-peer lending. It's companies called Lendix. They were 2 years old. Excuse me. They were 2 years late against the incumbent in France. But that was a team that I loved, Olivier Goua and Patrick Denonville. It's a huge market, and they brought something unique to the table. From day one, they were able to raise a fund to allow to invest in the SMEs. That was a very differentiated approach. Less than 6 months after the launch, they were dominating the French market. That means that it's not a matter of market, it's a matter of approach, how deep the team really understands the market. To answer to your question on what I am looking at currently, as I told you, insurance, peer-to-peer, I think it's something great. We saw project as early as 5 years ago, an Austrian project called Friendsurance. Very, very innovative approach. The unit economics did not make sense, but I got interested already 5 years ago, and of course, the coming mix of IoT and fintech is extraordinarily interesting.
Sean, do you have any views on peer-to-peer insurance?
Yeah, I think
or
it's
insurance or any other.
we're also very, and now apparently it's the thing, right? We've been spending a lot of time, probably starting at the beginning of last year, looking at insurance and seeing it. You know, I always say insurance is the original big data business, and actually within the firmament of financial services businesses, it's the one that probably most obviously is, you know, affected by or disruptable by technology. And ironically, vis-a-vis the banks, some of the insurance companies who always, I don't know how many people are banks or insurers here, but I used to be a banker, and insurance people are always the slow, sort of not so smart country cousins. It's not true at all. They move more slowly, but actually, in coming back to my context of this is a 20-year game, they're much more deliberate about it. I think there's probably more chance that insurance companies will successfully disrupt themselves than banks will. But it's an area that is extremely complex. On the surface, very simple, which is good. But when you get down below, it's extremely complex, not just regulatory, and understanding where those, you know, both Philippe and I have been talking about, where are the value drivers? Where can you do something that is really fundamentally different? And, you know, there's, you know, right now, so InsurTech's a thing, but there's lots of what I would call modern online or mobile brokerage type business models. Some of those will succeed for sure, and it's sort of obvious, but it's hard to make money when it's obvious as an investor. There's always an element of chance and serendipity in terms of when you've got sort of undifferentiated competitive new business models that are obvious. Picking the winner can be very, very hard, and in hindsight it's always super easy. That's a wonderful thing about investing. Hindsight is great, but at the time it can be hard. So we try to shy away from those, except for maybe when we find just an incredibly exceptional team, and then we go into it with our eyes open. This is going to be hyper competitive, and we're going to execute the hell out of it, and that's how we're going to win. What we like more is looking down, sort of digging in the bushes, in the undergrowth of financial services, where, you know, and that plays to our strength as a specialist investor, where, you know, people might not, it might not be obvious where that disruptive edge is.
And you mentioned regulation before. How much of a factor is that when you're making an investment, looking whether the company has all its ducks in a row, whether they're based in a country where the regulation is favorable?
Well, regulation is interesting because it's both an obstacle and a protection. At the beginning, it's an obstacle. What is interesting is that, for example, fintech started in London. Well, in Europe, fintech started in London for one simple reason: the 2008 crisis. After the 2008 crisis, the regulator eased and opened quite a lot of market, for example, in the FX market. On the contrary, as the crisis was much, I would say, not as strong in France, to be polite, the regulator didn't have the sense of urgency to open up the regulation. And when you look back now, 6 years with a 6-year time lag, you saw that fintech started in France almost 2 to 3 years later than in the UK. That's interesting because regulators was really a way to open up a market. At the same time, it's an obstacle because as the company is growing, more and more, the regulatory pressure is increasing, and that's for a fact. It's also protection for the incumbents. The incumbents being the fintechs that have been financed 3 or 4 years ago, because now the barrier has increased quite a lot, even in the UK. I finance Contox, and the team at Contox told me very recently, you know, if we were to start now, we wouldn't make it. The money we will need to invest just to comply with the regulatory pressure will make it very difficult to finance for VC.
Do you have anything to add on kind of the...
No, I would echo that. It's I mean, the way we look at it, it's a sine qua non. So when we look at any business, it's not just the regulatory framework, but it's the attitude and the culture of the founders. But regulations are, in some sense, easy in the sense that you can navigate them and you can understand them. You have to do the homework, but you can it's one of the easiest things to put a price on in the sort of all the known knowns and known unknowns and unknown unknowns. But it's also, if you come to it with the right attitude as a founding team, as a company, it's also potentially a hugely positive enabler. The kinds of companies that we invest in, this is another good criteria, testing is this something that the regulator will like? i.e., will it help consumers? Will it help systemic risks in the market if they succeed in prosecuting their business model? So oftentimes, and more, you're pushing on an open door. Just as an anecdote, we co-sponsored an event that convened, and the UK has a huge advantage because there's the FCA and maybe one or two other smaller agencies. But in December, we convened with Seth Wheeler, who's now the head of innovation at JP Morgan, but he had just spent 9 years the Treasury, the Fed, and then in the White House. And he convened all the regulators in Washington and the startup community. And this was apparently, and surprised us, the first time that really somebody had done that. And the message he was giving, and all the regulators were echoing him throughout the day, was, our door is open. If we listen to, the giants of Wall Street all the time, it's because they're the ones that are talking. You need to talk to us. And none of us became regulators to get rich or to create giant empires. We did it because and oftentimes it's part of a career, because we want to create a better system. So if you take that to heart as a startup founder, and instead of looking at regulation as this big scary black box, but sort of integrate it into your thinking from day one, can be a competitive advantage. But it does create an energy barrier, both in terms of the time it takes to get to market and the financing that you might need to do so.
I think we're running out of time. Yeah. Okay. So
oui, là, on arrive au terme de ce débat. Merci beaucoup. Sean Park, président fondateur d'Anthemis Group, Philip Cromwell, managing partner chez Partech Ventures, et Anna Herrera, journaliste chez Financial News.